Hey Moneymakers, it's Joshua Bellinger, and in this Follow the Money, I have an interesting bearish trade that was just put on that looks to be where in the next several weeks, this sector is going to continue to go lower. So take a look here at the XLF. What we see here is that the XLF has been weaker compared to the S&P 500. Now that yellow line that you see there, that's $21. I have that level highlighted because what we saw there was a very structured position that has big money behind it. So let's take a look here at the option montage. And I already have this trade highlighted or put together for us just to make it easier. So what we have on this is what's known in the retail market as a butterfly or put butterfly. The names don't really matter. Those are just gimmick names. How options or how trades are structured are more important because it's based on how we can identify where we think prices are going to go and how to structure positions around there. And that's the benefit of the option market, is that we can not just use directional bets, we can create structured opportunities to do a lot more with our money and to get better payoffs at the end of the day. So what we're seeing here is in the middle of this, we have a sell, and that's 8,000 contracts. This is the same exact trade that crossed the tape. What they did was they sold 8,000 of the 21 put in the August expiration. Now, they then bought the 23, 4,000 contracts of the 23, and then 19,000 all puts, 4,000 of the 19 put. So if we take a look here at the chart here, and we see that prices closed right at $23. So we have that right there. So this would be a level here, and then this is the body at the yellow, and then the 19 is right below there. So this is where we start to create the profit zone here. So if prices go lower, so if we just were long the 23 put and prices went to $21, we would profit. What they're showing us here, or whoever put this position on, is that they think prices will drop another $2. They do not think that it's going to go all the way to 17, back to March lows. But what they do think is that the continued weakness or relative weakness in this sector is going to continue to happen. It may not drop quickly, which is where structured positions work better, because that decay, if it's moving lower, decay on those options are, especially in the next 45 days, are going to pick up. So we start to see prices go lower. We could see prices go higher. But what they are looking at with this position, this structured option position, is that in the next, and we can look here at the next 49 days, they are looking to have a max payoff of that, where they're risking 35-cent debit, and if prices do expire in the next 49 days at that 21 strike, that $35 debit with the $2 difference on there is going to have a payoff of the difference. But if you take the $2 minus $2 minus 35 cents, that's the max payoff that you can have on this position here. So they're making that debit, that small little debit, where instead of just buying that 23 and playing it directionally, they're having direction but with structure. So it's a structured directional position here. And when we look at this chart and look at the relative weakness, this is an interesting position to put on for just 35 cents per contract and to be able to play weakness or have some kind of hedge, have a hedge in the portfolio or in our positioning, our overall option positions, to have these kind of bets. You want positions that pay off. You want to be able, with options, to be able to have opportunities that pay off with them if certain stocks go higher or certain sectors go higher, and also with weakness as well. So creating structured option positions is the same way, is a different way of diversification. So as we look here, the next 49 days, money's going into the XLF, and it's not betting the XLF shares go higher. It's betting that they go lower and they hit $21 in the next 49 days.